right. Welcome to this week's edition of If You Guys Could See What It Takes to Make This Show Go, You'd Be Crazy as We Are. Every time we set up a different place, it takes forever to get started, but you guys don't see all that. We just pop on the screen and start spitting out knowledge. But we've been doing this for about an hour trying to get it to work. So anyway, we're here, and we hope you guys are too.
Yeah, it's consistent with the craziness that's been going on all week.
Yeah, man. Well, I'd like to say I know what's going on, and I have no clue. I've been going to Mexico for the last week, and I don't really look tan because I don't tan. I'm Irish too much. But anyway, I have no idea what's going on. So tell me what's going on, Jerry. What's happening in the world?
You picked a good week to be gone. I mean, we had what they coined as Russia's Pearl Harbor last weekend. And apparently Ukraine took out a third of the Russian nuclear triad capability, or at least their ballistic missiles. So let's say they take out 30 to 40% of their ballistic missile capability. There has been no response yet. Supposedly a response is coming, but I don't know what, who knows what that could be. But I would argue it's way more than a Pearl Harbor event. I mean, if some country came in and took out a third of our ballistic missile capability, I don't think a week would go by without some kind of response. It just is unbelievable. It was no response from our administration, from Russia, from the stock market. The market just kept going up. Strangest thing. And then, of course, yesterday, huge public divorce between Trump and Elon Musk. That's going to reverberate for a while, but it's pretty hysterical. So anyway, the market's been basically moving sideways, and we'll kind of take a look at it. So we'll talk about what happened this week. Are we due for a summer correction? What the fear and greed index looks like. The bonus chart is Palantir, basically to demonstrate divergence, and the TSP fund charts. So, like I said, Monday, so actually over the weekend, we had Russia's Pearl Harbor, very little media coverage and no market response to date. We also had the ISM manufacturing PMI for May was 48.5. It's the third consecutive monthly contraction, right? So anything below 50, there's basically two halves of the economy, right? The manufacturing side and the services side. And so on either of those two, a reading below 50 means that part of the economy is in contraction. And we've had the third consecutive contraction, monthly contraction for the manufacturing side. And then the S&P was up 0.4% on Monday. Tuesday, we have the Jolts report, the job openings. So job openings actually rose to 7.39 million, and it was above the expected 7.1 million. So that's good news for the labor market, right? Amazingly, as much as there's all the talks about layoffs and everything else, the Jolts report is saying that companies are still putting out job openings on the street. And then the S&P is up 0.58%. Then on Wednesday, we get the 30-year mortgage rate that fell a little bit to 6.92% from 6.98% last week. We also had new mortgage applications falling 3.9% after they had already fallen 1.2% last week. Then on Wednesday, we got ISM services. So the ISM services PMI is the other side of the coin from the manufacturing. So services fell to 49.9. That's the first contraction reading, right below 50, since June of last year. And the S&P was up, basically flat, was up 0.01. This is what the services PMI looks like on a 3-year chart, okay? So we were saying since back here in June of last year was the last time it was below 50. But when you're below the 50 line, that half of the economy is contracting. And one of the big reasons in 2022 why we were not in a recession was because the services was way up here, right? For all of 22, services was up here above 50. They were kind of taking up the slack from manufacturing, which had been below 50 for quite a while. So the big question is going to be, like we said, we have 3 consecutive months where manufacturing is below 50, and now we have the first reading in a while where services is also below 50. So the economy is definitely weakening. Thursday, initial jobless claims are 247,000 versus 239,000 last week, and 243,000 were forecast. So a little bit up from what was forecast, a little bit up from last week. And again, a lot of people talking about initial jobless claims. The 4-week average rose to 235,000 from 230,500. So not big, huge moves. This is what the initial jobless claims, okay, on TradingView. If you go all the way back to 1978, we're talking about the lows in jobless claims, right? Historically, on any given month, were 280,000, right? From 78 to 2016, and a very low number was 280,000. And right now we're at 247,000 and people are kind of freaking out. Now it's all relative to time, but I'm just saying historically, are we seeing an uptick? Yes, but it's nowhere near what we ordinarily have in terms of initial jobless claims. If we kind of zoom in, to 2022, obviously this number was coming down after COVID, right? We had a huge number back here from COVID, and it kept falling for a long time into 2022, and then it started to stabilize out. And yeah, we put in I guess arguably a low here in 22, pretty much a double bottom here. It's starting to rise, right? So initial jobless claims are going up, but they're definitely not outside of this range. And even this range is much lower than what is historically normal. So I'm not too worried. If we did a big jump up to 280,000, that would be a big deal. But again, even that's like the historical low. So right now, the employment situation actually looks pretty good. And then Friday we had non-farm payroll was 139,000 versus 147,000 last week, but the unemployment rate remained at 4.2. It's been there for a while. So the unemployment rate and jobs and everything amazingly still looks good, regardless of what you hear all over the financial news media. Okay, so the summertime, we almost always have a correction. So what does it kind of look like this summer? If we go back to the top in January, this is the S&P 500, okay, a daily chart, S&P 500. So we go back to the top in January 2022. We had 3 moves down to the bottom, right, in October 2022. So the summer was basically what I did was make these boxes from the middle of April to the middle of July. So while we're in a bear market, that was a negative period for the market. And then once we flipped back into a bull market, at least for the past few years, from the middle of April to the middle of July was really bullish, right? So the sell in May and go away kind of idea hasn't worked for the last few years. So we had a big rally from mid-April to kind of mid-July. Had the same thing in 2024, right? We put in a bottom there in March and had a pretty good rally until mid-July. And same kind of thing here, right? This is the April 7th low. So from mid-April, where I started this box, this is going to be theoretically middle of July. Maybe we get a double top, from the February 19th high, and then start having the summer correction. That would be consistent with what we've seen over the past 3 years. So it's just kind of an idea to give you guys a little bit of perspective, historical, of when we tend to see these summer corrections, and they can be, relatively significant, right? Okay, so in anticipation, right, of a potential summer correction, one of the things that we expect to see is the fear and greed index being at extreme greed levels. You don't tend to see a top in the stock market at a 61 on fear and greed, or at least that's the rationale. The idea is that the fear and greed index it's a contrarian indicator. So when it gets up here at extreme greed, it's close to a market top. When it gets down here at extreme fear, it's close to a market bottom. It was 4. The level was 4 on April 7th. So it doesn't get too much more extreme fear than it was on April 7th. And of course, that was the bottom. So the idea is that it's a contrarian indicator. However, it doesn't always work out that way. Okay. So you can either look at the fear and greed index from the overview or from a timeline. And this is the overview view. Okay. It gives you the number and some of the historical data there. But the timeline view gives you back 1 year. Okay, basically 1 year. So what I'm saying is this was the top of the stock market on February 19th of this year. It was not obviously the peak in extreme greed. So extreme greed peaked out back here in October, and the market would come down, put in a bottom, people would get greedy again, the market would go up, come down, but we never got. We kept putting in lower highs in fear and greed, even though the market was going up. It's divergence, right? We're going to talk about that a little bit on the Palantir chart, but over time, when the fear and greed index is trending down and the market is trending up, it shows weakness in the market is what's happening. People are anticipating the market rolling over. These lower highs are an anticipation process, and eventually this was the high in the S&P. And then the market tanked into that 4 on that April 7th low. And so now we got back up, almost to extreme greed. We haven't gotten there yet. And on the pullback, we had just this little pullback in the last couple of weeks. Basically, the market went sideways, and kind of fear started coming back in. And now that people are getting kind of more excited that the market's going up. But basically, what I'm saying is we're at 61, 62. We're not in extreme fear levels. So in the big scheme of things, we should expect the market to go higher, which is consistent, right? If it goes higher into the middle of July. Okay, so Palantir. I just wanted to point this out because it's a really good example of divergence. So Palantir has been a huge winner this year. And from November last year, we were down here at $40, and at the high a few days ago, we're up $135. So really successful stock this year. We had a big pullback in the middle here. But what I wanted to point out is this divergence. So we had got a run up in Palantir, and it put in a peak in relative strength. And then price starts consolidating, but it's moving higher, right? So even though price is moving higher, the relative strength is decreasing, okay? So it's showing weakness even as price is moving higher, okay? And then we have this drop off. So then once relative strength bottoms out, and it only bottomed out here at 37.75, right? It didn't get oversold, which is why we didn't get a big move, real big move to the downside. But looking at the support levels of relative strength is pretty important. So this pullback was kind of anticipated based on the divergence between price moving higher and relative strength moving lower. Okay, and the same kind of thing here. This top was the top in relative strength, and then every time price went higher, we had a decrease in relative strength, and then eventually, we don't. So what we're anticipating is at least some kind of pullback in Palantir. So if we get a pullback to that roughly 37.75 level down here, ideally that would be above this low, right? Because then we still have higher highs and higher lows, and the trend keeps going up, right? So it's just the way that you would use relative strength and price chart and the divergence between those to kind of anticipate turning points. And you can absolutely do that. You can see it right now in the C fund. If you look at the chart of the S&P 500, there's certainly a divergence going on right now. Okay, TSP fund charts. So again, this is a weekly chart. of the S&P 500. Each one of these ticks is 1 week of price movement. This is the 20-week moving average line and the relative strength indicator on a weekly basis. So we had this big pullback in the first quarter. This was the April 7th bottom. We had the big rally, gap up like a month ago, and then we basically haven't gone anywhere. We've gone sideways. This is not a really, we're back above 50. And as long as we can hold support above 50 relative strength and the market keeps going higher, the C fund is a great place to be. If it rolls over and relative strength gets below 50, that's the best where we can hope for then is basically the 40 level. But if we get below 40, we're on the way down. So what we don't want to see is if this gap gets filled, we want to see support at that 20-week moving average line, and then the market moves higher. Right? All indications right now with a low fear and greed index and the fact that we have been going sideways, we've been consolidating for the last 4 weeks. That's good because usually the tops, you put in a top, it doesn't consolidate, it rolls over, right? Even back here, in 2022, once the top was in, the market starts rolling over. The consolidations are bullish. They tend to break out to the upside. S fund's doing the same thing, right? Had a big bottom in early April. It's been consolidating for the last 4 weeks. And again, every time you get a peak in the S fund, it rolls over hard, right? You don't tend to get a move up, a consolidation, and then a move down. You get a move up, a consolidation, and then another move higher. So the bias is that the market continues higher. Doesn't mean it's going to, but that's certainly the bias, especially when relative strength is above 50. I fund at this point, it's just so overvalued. Not to say that it can't keep going up, but it's due for a pullback in a big way. I would love to see a pullback back down to like 46. The 20-week moving average would catch up at that point if price was down here and we got support there. And that would be a great time to get in if we can get back down there. We're also pretty close to being overbought on a weekly basis on relative strength. And then the F fund, the bonds are the talk of the town in the financial world. And it's a very big question whether or not tariffs have a big influence or not on inflation. If inflation moves higher because of tariffs, the Fed is going to be in a very difficult place to try to lower rates. Of course, the administration wants the Fed to lower rates. So when rates go down, the price of the F fund goes up. When rates go up, the price of the F fund goes down. And we are kind of in this sort of triangle consolidation right now. So it's very likely to break one way or the other pretty soon. But right now, you could argue we're getting support at the 50 relative strength line. So that's kind of positive. So maybe rates do come down. But the F fund is definitely one to watch. And then the G fund continues up and to the right.
Funny how
Questions?
that happens. It's always going to go up and to the right.
The G fund, like at 4%, guaranteed rate of return for the year. Stocks, like I said, this is a pretty bullish presentation, right? It looks like the market wants to go higher. If you're getting into the market now, your risk is pretty high. If you've been in any time along the way since that April bottom, you have some gains that you could bank or leave on the table. There's nothing wrong with going to a 50-50 CG. Take some money off the table right now and wait for the next pullback. So we shall see.
That's just managing the risk reward, right? I mean, we talk about it all the time, but a lot of people don't put enough thought into. They just have this FOMO of like, oh my gosh, the market kept going and I missed out. But you took your risk off the table, and because you didn't know where it was going. You certainly would feel different if it turned the other way, and that's called gambling when you do it that way. So if you feel like you are in a place where you don't know where it's going to go, you don't have very much confidence in your next move, there is nothing wrong with taking some off the table or all of it off the table and putting it in G fund.
Yeah. And that's where the relative strength and some of the other indicators come into place, because if you're overbought, you can stay there for a long time and you just let that ride. But as soon as the overbought levels start to tick down, it's or you see divergence between price and relative strength, it's telling you that weakness is coming into the market.
That's it. All right, guys, if you want to see anything, see more like this, go to our website, growmytsp.com. If you have any questions, put them in the comments section wherever you find the video. If there's no comment section, shoot it over to support at growmytsp.com. And the support team will get it to us. Hope you guys are having a good time, great week, and we will see you next time.
Out of here.